Okay, let's unpack this. If you woke up this morning, October 30th, 2025, expecting a quiet day, well, think again. The global financial landscape is simultaneously being reshaped by some really high-stakes diplomacy, central bank policies going in wildly different directions, and frankly, a terrifyingly aggressive spending spree from big tech.
Absolutely. That confluence of events means we've got major market movers, geopolitics, monetary policy, corporate earnings. It's all hitting the tape today. So our mission here is to cut through that noise. We want to distill the most important nuggets, focusing on how these forces, which are really interconnected, are influencing key currency pairs, like, say, the USD/JPY, and the biggest names in equities.
Right, and the central tension today, I think, revolves around two massive numbers.
Yeah.
First, we need to explore the true cost of this U.S.-China trade truce. Because when you actually total up the financial commitments made by U.S. allies, the bill comes in at nearly $1 trillion. We really have to ask, is this peace, or is it, a structural demand for capital funding?
And the second tension point is that $78 billion question. That's the collective capital expenditure, the CapEx, spent by the biggest names in tech in the last quarter alone. And despite one key company hitting this massive $5 trillion valuation milestone, that relentless spending is raising some serious questions. Questions about an impending AI bubble, and maybe more importantly, the timeline for getting a return on that investment.
Okay, let's start where a lot of the market action began. The geopolitical maneuvering after the Trump-Xi meeting. President Trump declared it a 12 out of 10, which signals, major progress. But what did that progress actually cost?
Well, it was unquestionably a de-escalation win. I mean, the immediate, tangible concession from the U.S. side, a significant rollback of existing tariffs on Chinese goods, dropping them from 20% down to 10%. And the U.S. justification for this was citing an improved Chinese response regarding the control of fentanyl precursors. That's a crucial, immediate pressure relief point for both sides, really.
And China brought some big economic gestures to the table, too, right?
They did. They committed to immediately resuming purchases of what was described as tremendous amounts of U.S. soybeans, and there were suggestions of large U.S. energy deals as well. Strategically, we also saw a key one-year suspension of rare earth export restrictions coming from Beijing.
That rare earth suspension feels pretty significant.
Oh, it's strategically massive. For U.S. technology, for defense industries, it gives them breathing room. And furthermore, the U.S. agreed to pause extending sanctions that target Chinese subsidiaries, specifically those more than 50% owned by already sanctioned firms. They also extended some existing tariff suspensions for another year. So it creates this kind of functional truce. But importantly, it doesn't solve the long-term technology dispute.
Right, and that leads directly to the question of what wasn't discussed. Because while trade tariffs got rolled back, the U.S. side seemed pretty firm on core tech and security issues.
Exactly. There was no movement reported on providing China access to NVIDIA's advanced Blackwell chips, nor any adjustment to the long-standing U.S.-Taiwan policy. So this really underscores that while the economic sort of conflict is paused, the tech competition, the security disagreements, they remain intact just beneath the surface.
Okay, now let's pivot. Let's talk about the price paid by U.S. allies for this trade stability. Because the numbers here, these investment pledges secured from Japan and South Korea, they're just astonishing.
They are unprecedented. We're seeing these major capital commitments linked directly to securing continued trade relations, basically tariff avoidance. Japan, for instance, committed up to $550 billion in U.S. investment. To put that in context, that's equivalent to nearly 14% of Japan's entire GDP, or almost half its foreign currency reserves. It's huge.
Wow. And South Korea wasn't far behind.
No, they followed suit. A commitment of $350 billion in U.S. investment, and they had specific earmarks. $150 billion for shipbuilding projects, $200 billion through a broader investment framework. Interestingly, their commitment was capped, an annual investment cap of $20 billion, specifically designed, it seems, to avoid destabilizing the Korean won, which is quite telling in itself.
So when we combine those two numbers, we're looking at $900 billion in committed capital, flowing directly from key U.S. allies into the U.S. market. So let me ask you this. Is this really the price of trade security, or are we seeing a structural shift where the U.S. is effectively kind of mandating capital outflows from its allies to fund its own development?
Well, if we connect this to the bigger picture, that is precisely the fundamental concern being raised, especially by analysts in Tokyo and Seoul. The commitment provides an immediate, very tangible trade win and capital inflow for the U.S., no question. But for Japan and Korea, critics argue it risks this long-term industrial hollowing out, essentially transferring capital and potentially future industrial capacity to the U.S. U.S. just to maintain immediate access to the U.S. market.
It's a stunning economic maneuver, almost disguised as diplomacy. And the market reaction to these commitments is key too, right? Because that fear of capital flight is probably one factor pushing down the Japanese yen.
Absolutely. I mean, though some Japanese officials claim this money would come from existing dollar holdings, trying to minimize the immediate FX impact. The sheer scale causes market anxiety. This perceived structural pressure is now kind of interwoven with central bank policy. And that's where the JPY volatility really kicks in.
Right. Speaking of central banks, let's jump straight into that currency conundrum. The Bank of Japan's decision holding the policy rate at 0.5% for the sixth consecutive time that was mostly expected, wasn't it? But Governor Ueda's commentary, it sent a clear message of caution.
Yeah, the hold itself wasn't a surprise. The BOJ vote was 7-2. They're maintaining that cautious, data-dependent stance ahead of their critical December meeting. And Ueda was quite explicit. He cited the uncertainty around U.S. tariffs as a major factor for holding back on tightening policy right now. He basically said he needs to confirm that this aggressive wage setting we've seen from Japanese firms will continue regardless of potential U.S. tariff fallout before making a move.
And the market, it hated that caution, didn't it? The immediate reaction was yen weakness. It fell, briefly hitting, 153.89 against the dollar. Why the immediate dip if the hold itself was expected?
It's all about expectations. The market was looking for a stronger hint, a more concrete signal about a December hike, and they just didn't get it. Traders who had maybe positioned for a hawkish pivot had to unwind those bets, and that drove the JPY weaker. The message was essentially, we're worried about global factors like U.S. trade policy, so we wait.
But that short-term weakness, it stands in pretty sharp contrast to the longer-term outlook being discussed by some central bank veterans.
Yeah, what's fascinating here is the view from former BOJ Governor Kuroda. He recently stated that this current level, around 153, is too weak. His long-term forecast suggests the JPY will eventually rally significantly, maybe towards the 120-130 range, but this is predicated on one key assumption, the narrowing of the rate differential between the U.S. and Japan.
And that narrowing depends entirely on the Fed. Which brings us to yesterday's, shocker is maybe too strong, but significant move. Fed Chair Powell absolutely pushed back hard against market hopes for a December rate cut.
That was the crucial intervention. Powell called a December rate cut far from a foregone conclusion. That's pretty blunt language from a Fed chair. And that hawkishness immediately caused the USD to spike. U.S. Treasury yields rose across the curve. This divergence, you have a cautious waiting BOJ combined with a stubbornly hawkish Fed that's the engine driving near-term dollar strength. And it creates immense pressure on Asian central banks trying to manage currency weakness without, burning through their reserves.
Okay, shifting gears slightly over to Europe briefly. We actually saw some positive economic news there. It provides a stable, maybe not thrilling, but stable backdrop.
Yes, the Eurozone Q3 GDP print showed a decent surprise. A 0.2% quarter-over-quarter expansion, which beat expectations. This was primarily driven by strong French growth, actually. Came in at 0.5%. So that data gives the European Central Bank a comfortable buffer.
Which is important because the ECB has its rate decision coming up later today.
Precisely. They're widely expected to hold the deposit facility rate steady at 2.00%. The better-than-expected growth gives them the luxury of patience, really. It reduces any immediate pressure to ease policy and lets them focus squarely on inflation data.
Okay, here's where it gets really interesting, I think. The multi-billion-dollar question about big tech capital expenditure, CapEx. Earnings from giants like Meta and Microsoft were mixed, but the recurring theme was just the sheer shock of their aggressive spending plans.
We are witnessing an historic scale of investment, infrastructure investment, all in the name of AI. If you look at Alphabet, Meta, and Microsoft collectively, their CapEx in the recent quarter was roughly $78 billion. That represents a staggering 89% increase year over year, just enormous.
And they all revised future spending forecasts upwards too, right? Signaling this isn't just a one-off spike. I mean, Microsoft alone surprised the market with $34.9 billion in CapEx for the quarter. Why is this spending, which, theoretically, is fueling innovation, causing investors so much anxiety?
The anxiety seems to stem from two related fears. First, the return on investment timeline, and second, the possibility of an AI bubble. Look, massive, aggressive capital spending implies future growth, sure. But infrastructure takes time to monetize. For instance, Microsoft and Alphabet, they predominantly rely on their cloud services, Azure and Google Cloud, to monetize their AI spending. They sell capacity, processing power to external paying customers. So they have a relatively clear path to generating revenue from that, $78 billion outlay.
Okay, and that brings us to Meta, which seems to be the key point of investor skepticism here.
Correct. Meta's AI investments, they seem geared almost entirely toward internal use, primarily improving ad targeting on Instagram and Facebook, maybe funding longer-term metaverse projects. They lack that large external cloud monetization platform like Google or Microsoft. So investors are asking a critical question. Can internal efficiency gains, however large, truly justify billions in quarterly capex in the short term, especially when that capex looks set to keep escalating?
It almost sounds like the market is happy with companies selling the shovels in the gold rush, but worried about the ones just digging deeper holes for themselves.
That's a perfect analogy, actually. The ultimate winner in this AI arms race, NVIDIA, is absolutely thriving. It became the world's first $5 trillion market cap company in the regular session yesterday, just cementing its position as the undisputed king of AI infrastructure. Alphabet also performed strongly, largely insulated by its robust cloud sales figures.
But despite that internal big tech volatility, which feels pretty intense, overall market sentiment seems to be taking it in stride.
That is the interesting paradox, isn't it? U.S. equity futures were mixed, but generally pretty flat this morning, digesting this massive amount of news without real panic. And the VIX, which tracks expected market volatility, is actually trading lower, down around 16.06. This suggests a general cooling of market fear. It suggests that while the scale of AI spending is shocking, the overall economic trajectory and maybe the Fed's hawkish stance is keeping the markets somewhat anchored.
So as the U.S. market gets going, we need to quickly identify the immediate catalysts. What's going to either justify or undermine that surprisingly hawkish tone we heard from Fed Chair Powell?
Okay, the two key pieces of U.S. economic data we're watching this morning coming out at 8:30 a.m. Eastern Time are critical. We'll get the Q3 U.S. GDP print. Forecast is currently 3.8%. A hotter reading there will immediately justify the Fed's reluctance to talk about rate cuts. Alongside that, we'll see the Q3 PCE prices index. Forecast is 2.1% for the core index, I believe. If those inflation indicators remain sticky, well, the dollar strength we've seen is likely to persist.
And globally, the other major event today is the ECB.
Yes, the ECB interest rate decision comes at 9:15 a.m. Eastern, followed by President Lagarde's press conference at 9:45 a.m. Eastern. That will be crucial for the Euro-USD pair. Given that recent positive GDP print for the Eurozone, we'll be listening very closely for any subtle shifts in their patient outlook.
Okay, so what does this all mean for us right now? It's a day defined by, well, high-stakes diplomacy, securing a crucial, if maybe temporary, trade truce with China. Its currency market really struggling with this profound policy divergence. A highly cautious BOJ versus a stubbornly hawkish Fed. And it's a tech sector betting billions, $78 billion in one quarter on an AI future that clearly has some investors worried about a capex bubble, worried about delayed returns.
The enduring tension, though, I think, lies in those financial promises made by Japan and South Korea to the U.S., that $900 billion total. These were arguably presented as the unavoidable price, the price of avoiding crippling tariffs, of maintaining trade access. So maybe consider this. Does this massive capital commitment signal a new era of stable trade relations, deep industrial cooperation? Or has the price of avoiding tariffs simply shifted to potential long-term industrial hollowing out in Asia, funneling vast amounts of capital primarily into the American market? That's a deep dive question worth exploring on your own.
Thanks for joining the Deep Dive.